Alright, so picking up from the last updates, here's where we are now and what it actually means for markets. This is going to be a full picture update, not just headlines. Because right now, the biggest mistake traders and viewers are making is thinking ceasefire means the risk is over. That's not what markets are pricing. Welcome back to Yearn to Grow. This channel is about understanding finance and insurance clearly and calmly. No pressure, no shortcuts, just clarity. The ceasefire is alive on paper, but the battleground has shifted into shipping security, insurance risk, oil flows, and the psychological fear premium that can flip sentiment in minutes. So I'll explain what happened from May 6 onwards, what the current situation really looks like, and then I'll go deep into oil and gold. The levels, the triggers, what can break, what can fail, and then finally how this is affecting India, rupee, stocks, sectors, and why Indian markets react faster than most people expect. We have a lot to cover, so let's start with the timeline. Now first, May 6th. The big shift on May 6th was that negotiations started moving faster. Reuters reported that Iran was reviewing a US peace proposal. This proposal would formally end the war, but it still left the key US demands unresolved, especially the nuclear angle and the reopening of the Strait of Hormuz. The market read this as, okay, at least diplomacy is active again, and the moment diplomacy becomes active, you get a very specific market behavior. The risk premium starts to compress. That doesn't mean prices crash. It just means the fear premium stops expanding. That's why oil and risk assets moved on optimism, because the market is always forward-looking. It doesn't wait for a signed document. It starts moving when the probability of a deal shifts even slightly. This is the first lesson in geopolitical trading. Watch the momentum of the news, not just the event. Then May 7th. Reuters said something extremely important. The two sides have occasionally exchanged gunfire since the ceasefire took effect on April 7th. That sentence tells you everything about the real structure of this conflict. The ceasefire isn't a clean everything stopped. It's more like a ceiling on full-scale war. Below that ceiling, you still have incidents, harassment, drone threats, ship security problems, and small confrontations. For markets, these below-the-threshold events matter a lot. They keep the risk premium alive. It's like the market saying, yes, there is negotiation, but don't get too comfortable, because the battlefield itself is still active in the background. May 8, gold rose on peace deal hopes. Reuters put spot gold at 4,790.68, up 0.7%. Now normally when you hear peace deal hopes, you might think gold should fall. But here's why gold didn't just collapse. Because gold is not only a fear trade right now, it's also reacting to inflation expectations, rates expectations, and the oil shock. When oil rises because of geopolitics, it feeds inflation fear. That inflation fear can keep yields firm and keep rate cut hopes weaker, which usually caps gold. But at the same time, geopolitical uncertainty keeps safe haven demand alive. So gold is fighting two forces. That's why gold is hard to read right now. It's moving on two competing forces. May 9th. Reuters reported something very significant that most people ignore. Allies are already preparing for a post-war Hormuz security mission. The UK deployed HMS Dragon. It aligned with broader preparations like the UK and France discussing navigation protection. That tells you how global the Hormuz issue is. This isn't just Iran versus US. This is about a choke point that affects global energy flows and shipping insurance across the world. When allies prepare for security missions, the market reads it as a lack of confidence. They're preparing for force stability, meaning escorts, naval presence, and ongoing risk management even after diplomacy. The market knows that peace here is fragile and requires policing. May 9 to 10. The ceasefire holds, but drone and ship security tension continues. AP reported Iran warning against attacks on tankers and Bahrain announcing arrests. And the UAE reported the interception of Iranian drones. Again, the message is the same. Ceasefire doesn't mean calm. It means we are in a fragile phase. Now, where do things stand right now? The clean summary is this. The ceasefire is alive on paper, but repeatedly stressed by Hormuz incidents. It is a paper-thin peace. The US blockade of Iran's ports started April 13th remains a central lever. The main battlefield is the Strait of Hormuz for shipping, insurance, and energy risk premium. And diplomacy is active again because Iran is reviewing the US proposal. So you can imagine the market sitting between two worlds, one where a memorandum is signed and risk collapses, and another world where an incident triggers escalation and risk spikes. That's why the market is not trending smoothly. It's moving in bursts, reversals, and spikes. It is a high volatility environment. Now let's go deep into oil, because oil is the most honest indicator in this entire conflict. Oil is the thing that reacts first to real-world risk. It doesn't lie. According to the latest reference prices, Brent is around $159 as of May 8th, and WTI is around $95.42. These numbers matter because oil is sitting on a psychological pivot zone. The market is essentially asking, is this crisis fading into diplomacy? Or is it still capable of producing a new supply shock? The answer to that question determines the next 10% move. Why did oil move violently since April 6? It's simple. The ceasefire plan and Hormuz reopening talk removes risk premium. That pushes oil prices down. Simple supply and demand. But the April 13th blockade is a supply threat because it can keep Iranian barrels off the market. Reuters noted blocking Iran could keep around 2 million barrels per day off the market. That's not a small number. When you remove that supply, you change the global balance, and then every new Hormuz security headline instantly increases insurance and freight costs. The market reprices immediately for these costs. It's not just about the oil itself, it's about the cost of moving that oil through a war zone. That is the premium we are seeing. Now let's talk levels cleanly. For Brent, the first support is $100 to $99. Why? Because it's psychological and it's a pivot zone where people decide whether oil is expensive or cheap. If Brent holds above $100, it tells you the market still respects the risk premium. If Brent breaks below $99 and can't reclaim it, the market is starting to believe in de-escalation. Support 2 is $96 to $95. This is where deal optimism selling can test the floor. If the market fully buys the deal is near narrative, this zone becomes the next magnet for prices. If this breaks cleanly, the next major psychological support is around $90. No, $90 is not easy to reach. You only get to $90 if de-escalation becomes real, not just headlines. Real means ship traffic resumes, insurers relax, and the world stops fearing supply disruption. Until we see ships moving freely, $90 is a very optimistic target. Keep that in mind. On the resistance side, resistance 1 is around 102 fen. This matters because it's the area where small positive oil catalysts start to turn into much bigger moves. It's the gatekeeper. Resistance 2 is $105 to $110, and that is your headline spike zone. If the ceasefire cracks or you get a confirmed major incident in Hormuz, oil can jump straight into that zone. Because oil is a fear market during geopolitical stress. It doesn't climb slowly like a regular stock. It spikes. It moves on adrenaline and uncertainty. You need to be prepared for that. Now, what makes oil break up? 3 things. First, a confirmed shipping hit, mining, or major incident in Hormuz. Second, escalation that threatens physical flow, not just rhetoric. Markets are sick of rhetoric. They react hardest when flow is threatened. And third, any signal that Iran's exports stay restricted longer because blockade enforcement stays tight. And what makes oil fall hard? A signed memorandum plus visible reopening steps. Not just talks are going well. Visible steps like safe lanes operating and real ship traffic resuming. Also, clear de-escalation in drone and ship incidents, because the risk premium is literally priced on the probability of an incident. When incidents stop, the premium comes out instantly. Now, gold. Gold is more complex than oil. You gave 2 key reference points. May 5th around 4,557.56 after a 1-month low, and May 8th around 4,719.68. It's a tug of war. The reason gold is hard right now is the two forces fighting. War risk pushes gold up because it's a safe haven. It's where money goes when people are scared for their capital. But oil-driven inflation risk keeps yields and rates expectations firm. Higher yields cap gold because investors can earn more in fixed income without the volatility of a metal. So gold is being pulled up by fear and pushed down by yields. That's why gold behaves weirdly. Sometimes you get scary headlines and gold doesn't rally as much as people expect. It's dampened. Now let's map gold levels cleanly. Support 1 is 14,700s. That's the deal optimism pivot area. If gold holds above 4,700, it suggests safe haven demand is still strong and the market isn't sure. Support 2 is 4,460 to 4,450, the May 5 zone. That area is important because it's where buyers stepped in when gold dipped. It represents the buy the dip floor for traders. If gold breaks below that, then support 3 is $4,500, a major psychological level and also a zone where if the peace narrative strengthens, the market might be comfortable selling gold. Resistance 1 is $4,730 to $4,750, near recent highs. That's where gold tends to stall because sellers appear, especially if yields are firm. It's a tough ceiling to break through. Resistance 2 is 14,820, and that is a key zone because it was seen around the April 8th spike. If gold breaks above 14,820, it means the market is in full risk-off mode again. The deal is dead. What makes gold break up? Real ceasefire breaks, headlines, real strikes, widespread drone events, or anything that signals the conflict is leaving the controlled phase. That is the breakout trigger. Also, if oil spikes again and fear goes up, gold can rally, but it can be choppy because inflation also lifts yields. Gold can still rise, but with violent pullbacks. It won't be a smooth ride. What makes gold fall? A credible signed deal plus calm shipping. When risk premium drops, gold cools. Also, if markets fully price de-escalation, like when oil slips under $100, gold loses its bid. Now let's connect this to India, because India is one of the most sensitive countries to this story. This is personal for our markets. The chain of events is direct and powerful. The direct chain is simple. Hormuz risk pushes oil cost up. Oil cost up increases India's import bill, and that import bill up increases inflation risk. It's a domino effect. Inflation risk reduces RBI flexibility, and that creates rupee pressure and equity volatility. This is why Indian markets react quickly to oil headlines, sometimes faster than US markets, because oil is directly tied to India's macro stability. We import most of our energy, so any change in the global price is felt in every corner of our economy. You must understand this link. Now, what actually happened recently? 1. The rupee hit a record low when war risk was hot. 2. The rupee gained sharply when crude slid and agreement hopes rose. It tracks oil perfectly. And 3. Indian equities reacted similarly. They got support when oil eased. This is exactly what you should watch. India is trading the oil narrative through the rupee. That is the real trade. When oil rises, the rupee weakens. FIIs often get cautious and pull money out, and equities struggle. When oil falls, the rupee stabilizes and equities breathe. It's a predictable cycle. Watch the rupee. Now sectors. Negative if oil stays high. Airlines get hit because fuel costs kill margins. Paint and chemicals get hit because input costs rise directly with crude derivatives. It's a direct hit. Logistics gets hit because transport costs rise. OMC margins become a question mark depending on how the government manages fuel pricing and subsidies. These are the pressure points. Meanwhile, relative winners, upstream energy benefits, defense stocks get attention, and select commodities can rise. Diversification into these sectors is often the strategy when oil spikes. Now I'll give you a clean what happens next segment. Every masterclass needs a forward outlook. Here's the key message. The market is currently balanced between two very different outcomes. Outcome 1 is a signed memorandum and normalization. If that happens, oil can slowly drift down toward 96, 95 $95 at first, and maybe later test $90 if shipping truly stabilizes. That's the bull case. Gold can cool down toward $4,700 and possibly 4,560s. The rupee stabilizes, India gets inflation relief, and equities improve, especially consumption and rate-sensitive sectors. A sigh of relief. Outcome 2 is a ceasefire incident that changes everything. A tanker attack, drone strike, or a sharp breakdown in talks. If that happens, oil can quickly break 102.5 and spike toward $110. Gold can break 4,750 and aim for 4,820. India would feel it immediately. Rupee pressure returns, equities face volatility, and the market shifts into risk-off mode. It would be a sharp reversal. So if you ask me what matters most right now, it's not just the headlines. The real trigger is, are shipping incidents slowing down? Is insurance returning? Are tankers moving without fear? If yes, the risk premium keeps compressing and we move toward normalization. If no, one single incident can reverse everything in minutes. You must watch the physical reality of the strait. Now for your closing summary. As of now, the ceasefire exists, but it's fragile. The blockade remains a central lever. Hormuz is the main battlefield. Diplomacy is moving again. That's why oil is around $100 instead of $120. But the market is not convinced enough to remove the entire risk premium. That's why gold is still high and oil is still holding a premium. And for India, this is not just global news. This is directly rupee, inflation, RBI policy flexibility, and equity volatility. It is the core of our current economic story. Watch it closely. If this explanation helped you see things a little more clearly, that is exactly what this channel is meant for. We will continue breaking down finance and insurance concepts step by step. If you find this helpful, please like the video. Subscribe to the channel. Turn on notifications so you do not miss future videos. See you next time.